Kind of one of the remarkable things of this year is that almost everything got hit. So bonds, one of the worst years ever. Stocks, pretty bad year. Gold, was like flat. At one point it was up, then it was down. Now it's kind of flat for the year.
Bitcoin.
And obviously Bitcoin had a bad year. Growth stocks had a horrible year. A lot of those look like shit coins, basically. Like these unprofitable, super high valuation companies just got killed. So I think it's been somewhat surprising how resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth. I think for Bitcoin, my interest is in probably like infrastructure scaling. So things that Breeze is doing with Lightning. Yeah, it's been a pretty good year. Obviously, it's been a challenging one from a market's perspective, but from a business perspective, from meeting people, traveling around, I've certainly enjoyed the year. And so it's kind of different parts of the world going through different things at the moment. But for me, I've been fortunate enough that it's been a pretty enjoyable year. One of the best performing this year was ironically cash. So inflationary environment, it's ironic to buy cash. If you look in the U.S. System, if you hold dollars in a bank account, you're getting paid near zero most likely. But if you're holding short duration treasuries or money markets, you're at least getting several percentage points to offset some of that inflation. So cash is kind of like a safe haven to lose value slowly. Another thing that's actually gone up this year is a number of decent dividend paying value stocks, right, that went into the year pretty cheap and that have generally continued doing pretty good cash flows and paying pretty high dividends. A lot of those have actually been some of the best places you could be, right? So you did better than cash, you did better than gold, you did better than most risk assets that went down. And so those have been some of the best places to be. And of course, there's some specific sectors like energy stocks and things like that at varying points of the year did very well. But a general rule was cheap, profitable companies that pay dividends has generally been the best bet this year. Kind of one of the remarkable things of this year is that almost everything got hit. So bonds, one of the worst years ever. Stocks, pretty bad year. Gold, was like flat. At one point it was up, then it was down. Now it's kind of flat for the year.
Bitcoin.
And obviously Bitcoin had a bad year. Growth stocks had a horrible year. A lot of those look like shit coins, basically. Like these unprofitable, super high valuation companies just got killed. And so there's been a couple ways to, if you were like a fully long energy or something like that, you made a lot of money. But outside of being very specific, it was a pretty hard year to make money on. So it's more about damage control. So I think it's been somewhat surprising how resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. It depends on a few different variables. So right now, for example, the U.S. yield curve is inverted, which means that the 10-year treasury is a lower yield than the 3-month treasury. The last 8 recessions, the yield curve inverted before the recession, and there's been no false signals, right? So it's never inverted, and then there's no recession. Now, the caveat, though, is that sometimes it's like, a recession happens 2 months later, and sometimes it happens like 2 years later. So there's a pretty wide gap for how long it can take for a recession to materialize. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which, again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure. And so that's been a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth. So that's been a big story this year. And also, a stronger dollar puts some pressure on gold, kind of countering some of the other things that should be beneficial for gold. And then also, as we've seen, the whole crypto industry was just heavily intertwined and indebted. So that's the speculation pressure poured out. Things blew up. Obviously, Bitcoin got impacted by it, even though it wasn't at the heart of that whole thing. And so that's all been negative. Generally, if you look historically at Bitcoin's price action, it does follow global liquidity very closely. And so as liquidity pulls out, Bitcoin's done poorly. It's even done more poorly than I thought because some of the industries were so, like FTX blowing up this spectacularly was not really on most people's radar, for example. On the other hand, that gives assets that are not valued for earnings a chance to do better. So things like gold or Bitcoin, where they're more like liquidity plays or anti-dollar plays than earnings plays. And so I do think that you could see, for example, a bottom in Bitcoin before you see a bottom in equities. I do think you could have a better year for gold than you do for stocks, for example. I think that that's, as a base case, the type of year I'd expect for 2023, unless or until I start to see evidence that says otherwise. That's tricky. I think I can separate into macro and Bitcoin, I guess. I guess in macro, I want to see in the first half of the year, I want to see what happens with a lot of these indicators. So a lot of times the way I phrase things is like I'm very confident in how things are going to go for the next 6 months. And other times you're at more of a pivot point and like my uncertainty is higher. So for example, earlier this year, I was more like adamant of kind of risk off conditions. And now I'm kind of like, are we gonna keep that going into full on recession, or are we gonna kind of have like a kind of a global led rebound? And so my certainty in the next 6 months is like higher than it was, say, 8 months ago. I think for Bitcoin, my interest is in probably like infrastructure scaling. So things that Breeze is doing with Lightning, Breeze, Blockstream. Making kind of the back end more efficient. Things like Fedimint, I think they're going to be kind of at full gear throughout 2023. I think ways to make the network more private, more scalable, not just for Lightning, but just overall Bitcoin usage. Anything that makes Bitcoin more fungible and gives people a bigger range of options to use. So they can use the base layer, they can use Lightning, they can do something custodial if they want to. There's this whole kind of stack that they can pick whatever serves their need the most. And so for me, it's looking at kind of the classic bear market building situation. And so, for example, and I'm in a fortunate position because I advise Ego Death Capital, and I get to talk to the founders that we're looking to invest in or that we have invested in, and just kind of see the work that they're building and see what they plan to do and trying to do our best to help that happen. So I think recessions can last as little as a few months. I mean, on the other hand, the recession, amid the 2008 crisis was very long. It lasted well over a year. And so there are different impacts, both in the private sector and from the public sector, that can either shorten or lengthen a recession. Usually there's a trade-off with that, right? So if you have a recession and you print a ton of money and throw stimulus at it, you can get out of that recession quicker. But then you've done it at the cost of higher debt and then potentially for a more inflationary rebound in the future, which then you have to then raise rates super quickly and potentially put yourself into another recession. And so there are levers you can pull, but it's like every lever has like a cost associated with it. And so I think this could be a longer, more grindy type of environment that's maybe less deep than people think. So a lot of people are afraid of like a 2008 repeat. The reason I'm not, at least not as a base case, is because if you look at 2008, the U.S. banking system was very, very weak. It was very levered. So banks had a very low exposure to safe assets, like cash reserves or treasuries, and they had a very high exposure to real estate loans, subprime, auto loans, just all types of riskier assets that can lose nominal value. And that all imploded pretty severely. In the decade that followed, banks if you look at a bank balance sheet, it looks the opposite of how they looked in 2008. So they're actually overexposed historically to treasuries and cash, and they're underexposed to loans. I also look at unemployment. So historically in the US, if unemployment rises by 50 basis points, meaning 0.5%, like if you go from 4% unemployment to 4.5% unemployment, if you get that much, it never stops there. It just keeps going up for a period of time. And then you kind of get this like spiral into recession. And so, but I'm looking forward now to 2023 to see if we start to get more unemployment rate ticking up. And so that's what I would look at, the combination of PMIs, unemployment, and things like that, as well as, the Atlanta Fed does a pretty good real-time estimator for what the quarterly GDP is going to be like. So in this quarter, they've been tracking what they think is going to be by the end of the quarter, which of course isn't reported till the next quarter. All throughout next quarter, they'll be tracking it, which again, we won't find out till quarter two what quarter one's GDP was. So I look at that as a somewhat real-time estimate for at least the direction of where things are headed. If the U.S. has a recession, the Fed gets less hawkish, which likely takes some pressure off the dollar, which then gives the rest of the world a little bit of a reprieve. So you kind of have these like cascading things that, it all impacts them at once, but then one of the impacts starts undoing one of the other impacts. 2022 was mostly about valuation compression. So as the dollar was hardened, essentially, so higher rates, higher dollar index, that put a lot of valuation pressure on a lot of companies. So, it's not that companies' earnings fell apart. It's that, instead of paying 25 times earnings for a stock, people said, let me pay 18 times. Then you had unprofitable growth that got absolutely crushed. And a lot of this is because, if the 10-year treasury pays you 1% a year, and you want to then go into equities instead, you say, okay, what is the target rate of return I want on equities? And you might say, I want 5% better than treasuries. So I want at least a 6% return. And so you pay a pretty high multiple for those equities because you're comparing it to what is essentially a very overvalued treasury. On the other hand, if the treasury is yielding 4% and you still want a 6% equity risk premium, well, then you want a 10% return on your equities. And so you're going to pay a lower multiple for the same equities.